They told us it would be freedom. They told us it would be control. They told us the markets would adjust, that Britain would finally stand on its own 2 feet, liberated from Brussels and bureaucracy. But on the morning after the referendum, as the sun rose over London, something strange and deeply unsettling was happening. Trillions in value were evaporating. The pound was collapsing at a speed not seen in generations. Traders stared at their screens in disbelief, asking the same quiet question. How did a single vote manage to shake one of the world's oldest financial systems to its core? This is not just a story about politics or pride. It is a story about confidence, capital, and how fragile modern finance really is when belief breaks faster than institutions can react. To understand why Brexit became a financial shock rather than a simple policy change, you have to step back into the post-war architecture of Europe and the quiet deal Britain made with the modern financial world. After the devastation of the Second World War, Europe rebuilt itself not only with concrete and steel, but with agreements, trade agreements, regulatory agreements, currency agreements. Britain, once the center of a global empire, entered this new world cautiously. It joined the European Economic Community late, but when it did, something subtle happened. London transformed. The city became Europe's financial bridge to the world, a place where American capital, Asian savings, and European regulation all met. Banks did not just operate in Britain. They used Britain. Passports allowed financial firms licensed in London to sell services across the entire European Union. Clearinghouses processed trillions in euro-denominated trades. Insurance contracts written under British law protected assets across the continent. This system worked not because it was perfect, but because it was trusted. Trust is the invisible currency of finance, and for decades, Britain accumulated it slowly and carefully. The pound was not the euro, but it was stable. British courts were boring, predictable, and respected. British regulators were firm, but pragmatic. When global crises hit, capital often fled toward London, not away from it. That reputation became so strong that many forgot it could ever be lost. Brexit exposed how wrong that assumption was. The origins of the crisis were not financial at all. They were political, emotional, and deeply human. Years of slow wage growth, rising inequality, and cultural anxiety created fertile ground for resentment. The global financial crisis had already left scars. Austerity tightened public services. Migration became a lightning rod. The European Union, complex and distant, became an easy target. When the referendum was announced, most financial institutions quietly assumed it would never happen. Polls fluctuated, but markets priced in a Remain victory. This was the first crack in the system, a collective belief that rational economics would override political anger. As the campaign intensified, warnings grew louder. Economists issued reports. Central bankers gave speeches. International institutions urged caution. But something interesting happened. The more the financial establishment warned of disaster, the more some voters became convinced that disaster was exaggerated or even invented. In trying to protect the system, its defenders accidentally deepened the distrust toward it. Finance and politics drifted further apart, speaking different languages, answering different fears. On the night of the vote, as results trickled in from smaller districts, traders began to notice a pattern. Areas expected to vote Remain were flipping. The pound began to slide. At first, it was orderly, then it wasn't. As the scale of the result became clear, currency markets moved with breathtaking speed. Within hours, sterling experienced its largest one-day drop in modern history. This was not just a reaction to leaving the European Union, it was a repricing of uncertainty itself. Nobody knew what the future rules would be. Nobody knew which contracts still applied. Nobody knew where the legal boundaries now lay. When markets do not know, they do not wait. They run. Banks faced immediate questions. Would they still be able to serve European clients from London? Would derivatives contracts still be valid? Would euro clearing be forced to move to the continent? Share prices of major financial institutions plunged. Property funds froze. Withdrawals as investors rushed for the exit. International investors began to quietly reassess something they had not questioned in decades. Was Britain still a safe financial hub, or was it becoming a political gamble? The breaking point came not in a single crash, but in a prolonged erosion. Investment decisions were delayed. Projects were paused. Headquarters quietly considered relocation. The uncertainty was not dramatic enough to make headlines every day, but it was relentless. Each month, without clarity, acted like a slow leak in a tire. Capital did not flee all at once. It seeped away, deal by deal, office by office. The government scrambled to respond. Promises of smooth transitions filled speeches. Negotiations began, but negotiations themselves became a new source of volatility. Every deadline carried the threat of a cliff edge. Every speech by a minister moved markets. The Bank of England stepped in with emergency measures, cutting rates and injecting liquidity. These actions stabilized the immediate panic, but they could not restore certainty. Monetary policy can buy time. It cannot write trade agreements. One of the most revealing moments came years later. During the mini-budget crisis, a government announcement of unfunded tax cuts triggered a sudden collapse in the bond market. Pension funds, using complex financial strategies, faced margin calls. The central bank was forced into an emergency intervention to prevent a full-scale collapse. This was not a direct consequence of the original vote, but it followed the same pattern. Confidence had become conditional. Trust was no longer assumed. The financial system had become more brittle, not because it was smaller, but because belief in political competence had weakened. The fallout extended beyond Britain. European banks adjusted their exposure. Clearing operations fragmented. Costs rose. Efficiency fell. The promise that Brexit would simplify regulation gave way to a world of duplicated systems and parallel compliance. Global investors began to see a lesson that reached far beyond the United Kingdom. Political decisions could rewrite financial reality overnight. Attempts to fix the damage came in waves. Trade deals were announced with fanfare, but their economic impact was often modest. Regulatory divergence was promised as an advantage, but businesses hesitated to embrace rules that might cut them off from their largest market. Each fix addressed a symptom, not the underlying issue. The real problem was not access or tariffs. It was predictability. Markets can price almost anything except chaos. What makes the Brexit financial crisis so unsettling is how familiar it feels when viewed through the lens of modern history. We have seen this movie before. In the Asian financial crisis, confidence evaporated faster than reserves. In the Eurozone debt crisis, political hesitation amplified financial stress. In the global financial crisis, instruments designed to spread risk ended up concentrating it. Over and over again, the pattern repeats. Systems built on trust fail not when losses appear, but when belief disappears. Today, the parallels are impossible to ignore. Around the world, politics is becoming more volatile. Trade relationships are being questioned. Supply chains are being reshaped. Debt levels are higher than ever. Financial markets are faster, more interconnected, and more sensitive to narrative shifts. The lesson of Brexit is not that leaving a union is inherently catastrophic. It is that uncertainty, when combined with complex financial plumbing, can turn political choices into systemic shocks. Shocking data underscores this point. In the years following the vote, Britain experienced one of the weakest investment recoveries among advanced economies. The pound never fully regained its pre-referendum strength. Financial services employment shifted incrementally but persistently. None of these changes alone spell disaster. Together, they paint a picture of opportunity cost, of a path not taken, of compounding effects that only become visible with time. And this is where the delayed answer finally arrives. The mystery of how a single vote shook global markets is resolved not by focusing on the vote itself, but on what it revealed. It revealed how dependent modern finance is on shared rules. It revealed how quickly confidence can vanish when legal certainty is questioned. And it revealed how political narratives can override economic logic until the bill comes due. There are 3 takeaways worth holding on to. First, financial stability is less about strength and more about trust. You can have deep markets, sophisticated institutions, and advanced technology, and still be vulnerable if belief erodes. Second, uncertainty is a cost, even when no crisis is visible. It shows up slowly, quietly, and relentlessly. And third, political decisions in a globalized financial system do not stay local. They ripple outward, affecting investors, workers, and savers far beyond the ballot box. The warning is simple but uncomfortable. We live in a world where markets move faster than politics, but politics shapes the rules markets rely on. When the two drift apart, instability fills the gap. Brexit was not the end of Britain's financial story, but it was a reminder that no system, no matter how established, is immune to shocks born of uncertainty. So the open-ended question remains: in an era of rising polarization and rapid financial innovation, have we learned how to protect trust, or are we still gambling with it? If you want to understand the hidden forces that shape markets, history is the best guide we have. If this story helped you see the financial world more clearly, consider subscribing, sharing, and staying curious, because the next shock rarely looks dangerous until the moment it arrives.